Hello, everyone. Welcome to this month's edition of The Pitch. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. The Pitch is one of my favorite shows that we do regularly. We bring in 3 experts on the markets. We ask them to provide a pitch for 5 different stocks or ETFs, give us a little insight into their perspective and their process, and give us the opportunity to ask questions and discuss as a group what sort of themes are emerging from these 15 picks that our experts are providing. We have 3 of the best today, and I'm really excited to introduce our 3 panelists. First off, we have Jay Woods, who's a New York Stock Exchange Executive Floor Governor, Chief Market Strategist at DriveWealth, joining us from the floor of the NYSE. Jay, it's good to see you.
It's good to see you. I'm glad I got to pick our old stomping grounds. For those that don't know, David was here, and we did a nice little behind-the-scenes look at the stock exchange, and it's nice when I get a chance to come up here and talk to you.
That was an award-winning documentary, Jay. Let's not forget to give some credit to the StockCharts TV team. But it was fun. We were not far from where you're at, up in the balcony of the exchange. And thanks for coming on today. Second, we have Katie Stockton. Katie's the founder of Fairlead Strategies, joining us from Connecticut. Katie, it's good to see you again, and thanks for joining today.
You too, Dave. Good to see you guys. And I like the NYSE documentary too. I gave it a thumbs up.
And Katie recently releasing a new ETF ticker, TACK, T-A-C-K, from Fairlead Strategies. So congrats on that, Katie. Third, we have Jessica Inskip joining us from OptionsPlay in Florida. She's the director of education and product. Jessica, this is your first time joining us on The Pitch. I appreciate you bravely coming on and sharing some ideas, but it's good to meet you virtually. And thanks for coming on today.
Yeah, absolutely. Excited to be here. Really love StockCharts. So I'm really excited to share my process with you guys. Thank you.
So I feel like every time we've done The Pitch, it's sort of a fascinating time. Usually my introduction is these are unprecedented times. These are fascinating times. It's a choppy environment. We're seeing all of that. Even today, we're recording this on Thursday, April 21st. The market opened higher and just sort of pushing lower through the course of the day so far. A lot of heaviness in certain parts of the market, but a lot of uptrends to be had as well. So I'm really keen to see which names you guys are bringing to the forefront today. We're going to start, Jay, with you. We have your first chart lined up, and we're going with Kinder Morgan. Start us off and talk us through this idea.
Well, first of all, this is as simple as they get. I just have 2 lines, a resistance and support line. I'm not going to make it too difficult. But what I like to do is do that top-down approach and then look at multiple time frames. And, the last time I was here, I think we talked about energy stocks. And so let's look under the hood of the XLE. And one of those stocks in there that has been underperforming has been Kinder Morgan. Kinder Morgan is up 26% for the year. It broke out, it failed, but then it recaptured that nice little level and has been trending higher. Now, we could flag here. It did have earnings today. They beat, but it's trading above 20 for the first time in a long time. And let's look at the next chart, which is kind of the long time. We're trading at 52-week highs, which to me is always a sign of strength. But now, wow, let's go back in time and basic support resistance line. It tried to break out when? Pre-COVID. Pre-COVID is late 2019, early 2020. And it failed, and we kind of know why it failed. And now it's got its head above. So we look at things from a risk-reward point of view. And as a technician, the risk-reward is definitely in our favor. So, as long as we're trading above that support line, that old resistance line, now support, we're very positive on the stock. And does it have something to reverse? Well, it sure does. If it can get above the 22 level, which is a 10% gain from here, this thing could run. It could run very quickly back to that high $20, $30 level. So Kinder Morgan is something we're watching. And technically, I love the setup here.
Great start. We're going with energy overall. Pretty obviously very strong sector, but a really good start there with KMI. Katie Stockton, thanks again for joining us today. We are starting with your first pick, which is Bank of America, BAC. What's your thesis here?
I should say, Dave, that all of the ideas that we're going to present today are existing long recommendations that we published in our research. And I wanted to just showcase the kind of setup that we prefer right now. And the market is very homogenous in a way from a technical perspective. So you'll see some similarities in the chart, some themes from a technical perspective. And Bank of America, I think, is very representative of the broader sort of bank sector, even more broadly financials, maybe minus the insurers. The corrective phase that we've seen of about 25% for B of A has taken it right into some support on the chart. You can see it based on the cloud. The bottom boundary, the cloud provides a support. That's the shaded area on the chart. There's also a Fibonacci retracement level not far from the recent lows. And it's our belief, and this is probably out of consensus, that financials, because they are oversold, especially the banks in absolute and relative terms, that they could help the market extend its relief rally from March. So we are looking for a rotation back into some of these banks, even if it's just temporarily. So a rally would preserve that cloud-based support for Bank of America, but we think that the broader market is probably more range bound. So we still want to keep more of a short-term perspective on most of our long positions. So we are looking for Bank of America to make progress into the low 40s at a very minimum, and to take advantage of that bounce, which is still, I guess, not really counter trend, but in a way it kind of feels that way, just given the weakened momentum that we've seen across the board. The other dynamic here with Bank of America, of course, is regarding treasury yields. We would normally see bank stocks, especially regionals, do a bit better than they have done in a rising yield environment. And yet we haven't really seen that. And we think that has to do with the acceleration and the yield curve. So with any kind of alleviation there, perhaps we'll see folks revisit these bank stocks with their oversold readings.
Yeah, a number of these names have come off quite a bit, obviously, while others are doing a little bit better. It could be an interesting rotation if you see a move higher in Bank of America. Jessica, thank you for coming on for your first time. We're excited to have you on. We'll start with your first pick, Consolidated Edison, ED. What's the thesis here?
Yeah, so I started with my pick with Consolidated Edison. From a technical perspective, I'd see it going above that channel there, and it's hugging the top of the Bollinger Band. So I see that as strength in the upwards trend. So MACD is confirming that. And then I also added on RSI a line to the top at the 80, just so I can better gauge momentum for my bullish view on Consolidated Edison. But something that really fundamentally piqued my interest in why this security came up is they have a proposed sell-off of their clean energy. So I think that's actually going to give a good influx of cash, and positively from a fundamental perspective, give some good revenue. Therefore, the technicals are matching up. I have this as a solid buy.
Jessica, you've boldly selected a utility stock. I have to tell you, in the history of the pitch, I don't know if a utility name has ever come up. And that is actually maybe a perfect sign of the times, because it's hard to argue with the technical story that you beautifully outlined right there. That's a great first pick. Jay, we're back to you. Pick number 2 is Unum Group, UNM. Talk us through this one.
Yeah, you get giddy when we talk about utilities. It's fun to watch you get so excited. I dropped an American Water reference.
It's
on an
underrepresented, I feel like.
You were so happy. But I'm going back to a sector from our last pitch visit back in January. I brought out a chart of the IAK, which is the Insurance Select Spider Index, and the insurance stocks have done well. And I like to look under the hood once again, and I like to look at charts that are just breaking out. And this is textbook level 1 CMT stuff right in front of us. I even included a golden cross. And we're going to go to golden crosses later, and I'm not a fan of it, but sometimes when they show up and there's a history of them working, they do catch my eye. But we have here a perfectly rounded bottom, a level of resistance that broke out. It broke above, it flagged back down. Resistance became support, and now we're flagging higher to 52-week highs. It may be a little overdone over the near term, but long term, I like to do this. I like to go back and look at what has it done historically when it's made moves like this. So if we go to the next chart and we back it out to 2016, there's a similar setup in the fourth quarter. And my eyes are a little shaky on this. You see that breakout right there where you're circling. Thank you, Dave. The stock broke out of a similar base pattern like that, more of an inverted head and shoulders in that case, and it ran almost 50% from there. What is the similarity? Rates were rising at that time. So back in the end of 2016 to the peak of rates in 2018, we went from 1.85 to 2.9%, and we did it relatively quickly. What have we just done over the last 6 weeks? We've gone to 1.6, 1.5 to almost 3%. So that acceleration, and probably, pause hopefully, but consider that rates may continue to go higher with an active Fed. I think this is a great name to be in right now.
A really interesting parallel to that breakout in 16 and 17, Jay. Thanks for highlighting that. Katie, you are back up, and your second pick is ADI, Analog Devices. What's the thought here?
It has a very similar setup, maybe somewhat randomly, to Bank of America, in that it had about a 25% corrective phase. And that correction brought it into some key support based on both the cloud model that you see there on the chart, and also based on a Fibonacci retracement level. That's where it became oversold from an intermediate term perspective based on the weekly stochastics. And with that, the reaction that we've seen from those oversold conditions, we're starting to see a little bit of improvement in intermediate term momentum. This is somewhat broad based, and it's the reason why we're holding out for a little bit more of a relief rally here, in that the weekly MACDs, so a preferred gauge of sort of intermediate term momentum, they seem to be turning the corners. They seem on their way towards crossovers, which we see as buy signals. And in this tape, which is a bit of a weaker tape, perhaps the buy signals have a shorter duration, several weeks, as opposed to a couple, maybe 4 months or something like that. But we'll take what we can get. And with ADI, it came into some short-term support, made a higher low, and now has about 5% upside to its 200-day or 40-week moving average, which is the initial resistance. And of course, above that, that should free it up for a little follow-through as well. So this is a preferred way to take advantage of semiconductor upside leadership, if indeed the market does extend higher.
I'm seeing a theme here with your picks, Katie, of stocks bouncing out of their cloud, which is an interesting thing we might get to in the Q&A portion of the discussion. Jessica, you're back up to go, and Goldman Sachs GS is your second pick. What's the discussion here?
Yeah, this one, it feels a slight contrarian, but I'm looking at a couple things. So whenever I see a security like this one, where it's kind of stuck in its consolidation zone, which when it's consolidating, I'm looking for it to move upwards or downwards. Like that's the point where it's going to change trend. I see some bullish divergence, which I've put on the MACD down there at the bottom. And I actually see it maybe a little bit there on RSI. So since the security is hitting lower lows and relative to the consolidation that it's in, I want to see both of those indicators matching, and they are not. Therefore, it's giving me an indication that there's bullish divergence. It's piercing the cloud. I want to see it. I want to see MACD go above the zero line, go through the cloud, through that support zone, and then I'm going to be good on this security.
Interesting. A number of financial names starting to come up in the discussion, which is really interesting. We're to our third picks, Jay. We're back to you, and we're going with the Aerospace and Defense ETF, ITA. What's your thought here?
Yeah, well, this kind of looks like the last chart I showed you with that nice rounded bottom and a major level of resistance that we tried to break through and we're failing. So once again, we look at things from a risk-reward setup. And right now we feel that setup's in favor if it's trading above about 112.5, 113. Right now it's trying, but it's failing. But given that, this is one of the sectors that's in the news, then if you look under the hood, you have Raytheon. We don't want to look at Boeing. That chart looks horrible. But Raytheon, Lockheed Martin, Northrop, and Level 3 Harris, 4 of the top 5 holdings in this index really look good technically. In fact, they're all flagging outside of Boeing. So underneath the hood, it looks good. Right now, I wouldn't be jumping into this name, but it's one you have to watch on the technical basis. And then let's back it out. Let's look at something that I just teased you with before. We're right at that, COVID high, those highs back in early 2020. And then I circled a few golden crosses. This just caught my eye. It just happened again. The last two were 12 and 16% gains once the Golden Cross was formed. The one before that was 70%. So do I think you have to buy it because the Golden Cross? No, these are lagging indicators. The Death Cross is the worst of them all. But right now, I think the setup is if it's trading above the 50-day moving average and you can buy it on the break above this resistance level, it will definitely try to test those old highs back in 2020. And if it gets above there, given some of the backdrop we're seeing in the world, it could be a sector that really takes off.
Series of great charts here, and this third one is a very interesting one with some short-term weakness. But you're right, the long-term potential for breakout. There's a history there. Katie, we're on to your third pick, and here we are. Yum Brands, YUM. What are we thinking here?
Well, I wanted to get some diversity on the sector front, if not in terms of the charts. It's another one that we've seen a corrective phase within a long-term uptrend defined by the cloud model. Support was discovered last month, and now we've seen a recovery that has lifted the weekly stochastics from oversold territory. We like to see that. We like to see that reaction to oversold readings. That to us not only preserves support, but suggests that we can see additional upside by Yum, which is now testing its 200-day moving average. It's just north of 125. A breakout above that would support upside follow through, act as a nice positive technical catalyst, with the next minor hurdle around 129 for the stock. We think it is somewhat compelling as well in relative terms, meaning it's underperformed for, I guess, really a couple of months overall versus the broader market, and now seems to be rising from what was an oversold low relative to the S&P 500. So we're looking for not only upside follow through in absolute terms, but a near-term outperformance by Yum as it tries to sort of reassert that longer-term uptrend.
Very, very good. Third pick is Yum. We're back to you, Jessica. I'm bringing up your third pick now, which is Interactive Brokers, IBKR. So staying in the financial sector, what's the thought here?
Yeah, this is actually my favorite chart of the ones submitted. So talking about interest rates for one brief moment and margin balances. So that is a huge component of IB's revenue, the margin lending and securities lending. So when interest rates rise, they can charge you a little bit more. Therefore, they're going to have more revenue. So that's something positive that's really making me look into this from a fundamental perspective, is their net interest income. From a technical perspective, I see a lot of things happening here. I see it going above that support zone that I've created with those, where exactly where your mouse is. And I also see another form of bullish divergence with RSI at the top, piercing into the cloud. And I just want MACD to go right above zero, and I'm going to enter a trade the second that happens.
It's really interesting, Jessica, on a number of your observations. You've talked about that relationship between the fundamental stories and the technicals. And we'll get to that in the Q&A. I'd love to pick your brain a little bit more about how you think about that relationship. We're on to the fourth picks. Jay, you're back up, and we're going to healthcare with Biogen. First healthcare name coming out today. What's the thought here?
Yeah, I mean, I would have loved to have gone with UNH. The stock has been in a beautiful uptrend, but I wanted to look at something as a mean reversion play, as something that may be turning the corner. Just to tease the audience, I may or may not have picked this one in your stocks draft show coming up next week. But here's a stock that's been under tremendous pressure. It's down 45% from its high. It had a long, consistent downtrend going back to last June, and it broke. So right away, your tentacles go up, and you're looking at this. And when it sold off, it made a higher low. So right now, you get a mean reversion play. You've got 25% upside, just the 200-day moving average. Now, long term, it's got a lot of work to do. It's a downward sloping 200-day moving average. It has potential to be overbought on an RSI level. There was no divergence there that really attracted me to it. But seeing that the XBI has started to turn up, and this being one of the leaders in that index, I thought from a risk-reward point of view, which is how we always measure things on our side of the spectrum here at the New York Stock Exchange, I think the setup is good over the near term.
It's a great chart and a nice illustration of that rotation to more of what I'd probably call an accumulation phase, right? And a lot of those names like UNH have had really good runs. Biogen's been lagging behind a little bit, but really starting to improve. It's a great chart to highlight, Jay. Thank you for that. Katie, we're on to your fourth pick. We're going to AGCO. Here it is. Talk us through this one.
Well, we came across AGCO after looking at charts of Caterpillar and Deere, which of course have broken out above short-term resistance levels. We wanted to find a name that could leverage that same kind of momentum, sort of a loose peer of those names. And we found AGCO to have some of the similar characteristics. It has positive momentum, and that really is across time horizons. It also has exhibited very strong relative strength this year. So year to date, versus the S&P 500, we have seen very good outperformance from this name. So we don't want our entire sort of recommended list to be turnarounds. And of course, this is more of an established intermediate term uptrend. You can see that in the rising 50-day moving average, which you don't have out in that chart, but also even in the rising cloud-based support level. A short-term breakout for AGCO would occur above about 150, very minor resistance level from last month. And that would target the highs of about 155, 156. And we see no signs of upside exhaustion. Importantly, we do focus on overbought, oversold measures, whether it's the stochastics or the DeMark indicators for any kind of exhaustive signals. And we'd be really respectful of those in this kind of market environment. And yet AGCO does not have any of those exhaustive indications yet. So we want to just stay on the right side of the momentum there.
This is one of those examples where I feel like the weekly MACD makes this game super simple, right? If only they were all this straightforward, but you see how it's just perfectly tracking this rotation on AGCO. That's a great name to highlight. Jessica, we're on for your fourth pick, which is Gartner Group, IT in the technology space. What's the idea here?
Yeah, Gartner. So from a technical perspective, I'll start with that one this time, and then we'll go into the fundamentals. A lot of positives. They are bounced above the cloud. So I'm going to look for them to hit that resistance zone. And if it tests it, so that's going to be a short-term positive mood for me. Otherwise, every other indicator is giving me positive momentum. So this is solid from a technical perspective. From a fundamental perspective, performing really well. They've got earnings coming on May 3rd. They consistently beat their earnings by 40%. And I'm going to look for that again. On their guidance from the previous earnings, they said that a lot of their conferences where a lot of their sales come from were going to be virtual. They're actually, most of them are in person. If you look at their website, and historically their in-person conferences led to a lot of sales. So therefore they might have better earnings than anticipated due to that change from guidance.
Very, very interesting. I'm often asked, what does a good earnings stock look like from a technical perspective? This shot of Gartner seeing these gaps every 3 months or so sort of shows you how that has played out. And it's a really good example to highlight. And thanks for talking about that interplay between those different disciplines. We are now to everyone's final pick, and then we'll start discussing these as a whole. Jay, you're giving us a short idea here. This is Renaissance IPO ETF, ticker IPO.
Yeah, this is just a hot mess if you look at it. There's a fundamental and a technical view of it right now. You can make the argument that, well, you're seeing some positive divergence in the RSI. The MACD isn't as negative as it once was, but to me, it's rolling over on the MACD side of things. The IPO, to me, you have a 10% downside, and it can happen very quickly to old resistance, which could become new support. But the sector basically covers recent IPOs. It goes back 2 years. These are recent IPOs that are not in any of the major indexes: Uber, CrowdStrike, Snowflake, Datadog, to name a few. It also has Coinbase, Affirm, and Rivian. And these are charts of stocks that are just in no man's land. And then from a fundamental point of view, there was only one IPO here at the New York Stock Exchange in the last 2 months. It was a small energy stock. The pipeline is robust, but people are staying on the sidelines. And if you are bearish overall and in a rising rate environment, you're not going to see many high growth names come to market. So this is one of those ETFs that when it's hot, you got to enjoy the ride. But right now, I fear there could be another leg and a fast leg lower.
It's such an interesting theme to highlight, Jay. I know on social media, I recently asked people about, name one IPO that's been a good play over the last year. There aren't many of them. And my chart list of recent IPOs, there are a lot of things going down and to the right, to be honest with you. It's been a challenging environment for sure. Katie, we're on to your final pick, which is PLD. Talk us through this one.
Well, so here you finally have a breakout to a new high, and it's not something that we're seeing a whole lot of in this environment. So it does make us pay attention. When a resistance level, especially a final resistance level, is cleared, as with Prologis, we do tend to see good upside follow through. It may be challenged from a top down perspective, but if you look at a very classic sort of measured move projection, which just assumes the trajectory of the uptrend will maintain itself, you can arrive at a target of about 184 for Prologis. And I think that it is supported by intermediate term momentum. It does have rising moving averages, rising clouds support as well. And so to me, this is just sort of a nice trend following name with a nice positive catalyst to take advantage of. And we've really seen outperformance from the REIT sector more broadly. Sector had been range in relative terms for really months and months and months, and just recently has broken out in relative terms. Perhaps it's a little bit stretched alongside some of the other more defensive sectors of the market in relative terms, because we've seen massive outperformance of late from utilities, staples, REITs, even parts of healthcare. So perhaps that phase of outperformance will peter off a little bit here if we get into a risk on mode. And yet, when you look at these in absolute terms, they are pretty compelling, especially beyond the very near term.
Katie, this is a day of firsts on the pitch. I don't know if we've ever had a real estate name pitched either, but it's interesting. I mean, again, the charts speak for themselves. I know when I was scanning for stocks making new highs earlier today, had a lot of real estate, a lot of utilities in there. So I'm not surprised that they're kind of popping up in all of your processes as well. Jessica, we're on to your final pick. A local name for us here in the Seattle area. So thank you for finishing off with a nice nod to Seattle. Alaska Air Group, ALK. What's the thesis here?
Yeah. So I wanted to look at the airline stocks, and I've been looking a lot at them now just for the economy as a whole and welcoming travel. I certainly would love to travel myself, but nonetheless, the Bollinger Bands are actually tightening, which is something I look for because they're based off of standard deviation. So there's less variance within the price. So I can really look for a change there. So that is extremely positive. It's above the cloud. RSI is looking positive as well. So I'm really positive with this one from a technical perspective, especially that really, really, really wide support zone that you see I have there. And I actually have a longer time frame than the rest of my charts on here due to the impact of airlines had with COVID. So it's important to look at it from that perspective as well. And it's moved above that support or old resistance zones now. And that's very positive for me. And fundamentally, rising fuel prices is something that's definitely going to be a concern for airline stocks. But because Alaska Airlines is more West Coast oriented and a lot of their routes are on the West Coast, the rising fuel costs are actually more predominantly in Northeast and New York. They're double the price actually. So it doesn't affect them as much. And it looks like the crude oil has peaked. We'll hope it stays that way, but this looks like a solid buy just due to the way that it's ran and the infrastructure and the charts telling me it's a buy.
It's an excellent pitch there. And it's interesting. A lot of the airlines, obviously, a number of them reporting earnings this week. You have Southwest, UAL, and a number of them bouncing up this week so far. Guys, this has been great. I want to recap the names that you shared with us, and let's get to a good discussion. So starting off, Jay Woods, you had 5 ideas for us. Couple ETFs that we went through. We went through the Renaissance IPO ETF. That was a short idea, looking at some of the weakness in the IPO space. In basically the industrial sector, we have ITA, the Aerospace and Defense ETF. Then an energy name, Kinder Morgan, KMI. We have Unum Group, UNM, which is an insurance stock. And then Biogen, BIIB, which you may or may not have selected in our StockCharts pitch, which will be airing next week on StockCharts TV. Katie Stockton, you went next, and you had 5 picks for us as well. Consumer discretionary, you had Yum Brands, YUM. We had a financial name, Bank of America, BAC. Went into industrials and had AGCO, AGCO. We had Prologis, PLD, which is a real estate name. And then it's technology. I think the only semiconductor stock, actually, the only tech name we had today was ADI, Analog Devices. Jessica Inskip joining us for the first time. You did very, very well with 5 solid pitches. We had 2 in the financial sector, GS, Goldman Sachs, and an interactive brokers, IBKR. A nod to Seattle with Alaska Air Group, ALK, and talking about airline strength. Gartner Group, IT, which is in technology, and then Consolidated Edison, as I mentioned, I think the first utility name that we've highlighted on the group. Let's rotate to more of the discussion part of this, guys. This was great, and what I love about this show is the viewers get a chance to see three really knowledgeable practitioners applying your craft and trying to understand, how you were looking at things. I'd love to start with you, Katie. You talked a lot about trend following. And your last idea was a stock that was actually breaking to the upside, but some of your earlier names were actually showing some short-term weakness, right? These are names that were down at the lower end of the cloud model. When you're looking at the equity space, how do you balance looking for breakouts and looking for short-term weakness? How do you combine those in a meaningful way as an investor?
I mean, it's actually sort of a barbell strategy, right? We're looking for both oversold upturns and turnaround plays, and then we're also comfortable buying breakouts typically. In an environment like this where we're not seeing a lot of breakouts, we have to get a little bit more creative in terms of the ideas that we're willing to consider. And so with the turnarounds, they are more opportunistic, which to us means they're higher risk and tend to be a bit shorter term. And yet that's what we think the market's lending itself to right now, where we are forced to be a bit more short term in our focus. So we're very comfortable holding the long ideas that are exhibiting upside momentum, especially if you look at things like those weekly MACDs, and favoring the names that do have support intact. And for us, we like to look at the weekly cloud model to gauge that sort of longer term support level. And yet we are very comfortable when the market's in risk on mode, taking advantage of some of these oversold upturns, especially if they're occurring both in absolute and relative terms. We do give a lot of weight to the DeMark indicators, and the DeMark indicators can help us understand when some of these relative strength ratios get very oversold to the point where they're overdone on the downside. And that's what the kind of sector rotation work that we like to employ. So letting kind of the top down views trickle into our individual stock ideas. So very, very, a lot of attention of ours goes from those sector relative strength postures to then the stocks that we're choosing and recommending to our clients.
Yeah, Jay and Jessica, I mean, you brought up a great point, Katie, about sort of the macro versus micro. We're in this environment where I feel like it's interesting. We have a lot of competing narratives, a lot of macro headwinds and tailwinds to different sectors. But from an individual stock perspective, you've seen a lot of things are moving very, very well. Jay or Jessica, how do you balance that macro versus micro when you're trying to come up with ideas like we did here today?
Ladies first.
Oh, thank you, Jay. I appreciate it.
Yeah, you're welcome. No problem.
I think it's an interesting environment. And traditionally, and you made that comment earlier, how I look at fundamentals as well. And that's something that's important to me to balance types of environments like this, because technical analysis traditionally is, you don't need to look at the fundamentals. You believe that it's priced into the security, therefore it's reflected. And that's the fundamentals that you learning technical analysis. However, in times of uncertainty where there's other economic factors, then that comes into play, because even though it is certainly pricing in, I just look for harmony in both. And if you have a balance in both, I think it really helps validate and navigate those type of environments.
Really good point. I know, Jessica, we both have Fidelity in our backgrounds. I know when I spent time with equity money managers there, sort of the Peter Lynch mentality when I was there was certainly pretty prominent. And, I was taught, look for good stories and good themes in any environment. And it seems like now we're sort of seeing that play out where stocks are working in some cases, despite the fact that headwinds are out there. Jay, how do you think about that relationship, macro versus micro, in your work?
Yeah, I try to block out the noise. And when we say noise, we talk about the news, because, everyone's talking about rate hikes. Everyone's talking about the black swan that could be an escalation of a war, and you follow price. Now, I look at things in a different way now than I did a year ago, coming from the trading world where long-term for me was 5 minutes. And now that I'm on the market strategist side and talking to groups and doing more educational things, we take the step back. We look at the long-term. And that's why some of the charts, I wanted to look on multiple time frames and take the big picture approach. But, I do look for MACD crossovers and RSI divergence. I'm not much of a DeMark guy. Mark Newton and I used to have conversations about that down here. But, the top-down approach is always the best way of looking at
Mm.
things for me. And the sectors that are leading, which, kudos to Katie. I was looking at TAC. I wanted to use it. For those that don't know, it's the Fairlead Tactical Sector ETF that she and her team just launched. And I wanted to just use it because it's in a nice short-term uptrend because it's only been around for a few weeks. But where is it basically focused on? The strength in this market, the staples, the energy, the real estate. And you go under the hood and you look at it. So these macro events, I focused on ITA because the defense sector is in play right now because of those macro events. But price dictates how I move, how I trade, how I balance my portfolio. And most of the time, my personal trading, long-term approach, short-term approach, I look at a whole bunch of different indicators. VWAP strategies are big. Brian Shannon's school of anchored VWAP is always a go-to for me as well.
Jay, let the record show Jay Woods from the floor of the New York Stock Exchange brought epic long-term weekly charts with him. Let that be a lesson to traders everywhere to have a good recognition of the long-term big picture, right?
Yeah. Crazy.
So it's interesting when I look at take all of your picks together and sort of look what we as a group came up with today. Notable defensive feel to the discussion, versus when we've done this, last year at times, of course, when it was more of a growth-oriented environment. So more of a defensive feel. And I'm curious, just sticking with this macro theme, at what point was there something you would see that would make you think a little more on offense and get away from some of the defensive sectors and take a more aggressive bet? Is there something big picture that you would need to see structurally on a chart of the S&P and the NASDAQ to get more optimistic, any of you? Or is it just until the charts, sort of indicate that rotation has happened? Katie, how would you think about that?
The damage is done to some extent on the long-term charts. When you look at the monthly bars and the monthly indicators, we have either overbought sell signals or momentum that's really deteriorated. So they're a bit of a slow-moving ship in a way. Mm-hmm. It takes time. They operate with a lag because they're reacting to price action. And so it will take time for those monthly gauges to look better. So what we can do and what we do is refer to the intermediate term indicators that we use on the weekly bar charts. And for us, the first step towards a more sort of lasting risk on type of environment would be widespread buy signals or bullish crossovers in the weekly MACDs. We are seeing them in some areas of the market. They're not widespread yet, I would say, but at least that could enhance the shelf life of what we saw off of the March low by the major indices in terms of an impressive relief rally. And again, we'll just take what we can get and kind of be fluid in how we're following these momentum gauges. If those weekly gauges turn up and then they impact the longer term gauges in a favorable way, well, great, then we'll get on board more longer term. But as it stands, we're going to trust in the current posture of the long-term gauges to believe that at best, we're probably in more of a range-bound environment this year. We've been making a comparison to 2018 in that regard. And as you recall, in Q4 of 2018, right when Treasury yields reached 3.25%, we saw a 20% correction in the S&P 500. So we do think that at some point this year, we're going to get another proper downdraft. And we've got that in the back of our mind as we're evaluating these gauges.
Yeah, there's a little bit of pain there at the end of 2018 you're bringing up. And it's interesting as you're talking about that rotation, it strikes me a lot of technology names and others, sort of in that negative trend. And AGCO is an example of how a stock can rotate into more of a constructive trend. You see that more widespread. I could totally get the argument to get more into that. Jessica, you had an opportunity to pick any of the FANG stocks and you decided not to. When you're looking, obviously stocks like Netflix, Meta platforms have been struggling, but even some of the ones that are maybe a little more defensive, like a Microsoft or an Apple, are holding up a little bit better. What would you need to see in a chart of like a Microsoft or an Apple to draw your attention to it versus what you've seen so far?
Yeah, I actually looked at every single one of those prior to picking, and I did not choose one as a solid buy, which is interesting. And I want to like metaverse, honestly. My son has a VR headset. He's in the metaverse all the time. He's 11 years old and he was selling life insurance. I have no idea how, but that's what I overheard. But I think it's interesting to me. And in my previous firm, I know there was a huge investment that they made into advertising and platforms. So I think that's just Web 3.0 and things like that are things of the future that I think are interesting. And Facebook or Metaverse now, it would be leading that. From that perspective, I would love to be very bullish on it. But from the chart perspective, it's not there for me. So therefore, I'm not going to enter in at that moment. So what I would need to see is just one indication giving me a bullish flag. And then I would need another confirmation from there. So I vary my indicators. It really honestly depends on my mood, which indicator I pull. But I look for a bullish signal. I won't initiate a buy with just one bullish signal. I want it to be confirmed with one or two others.
Yeah. Jay, when you were looking at some of these names, particularly the larger names, right? And when you look at how the market is doing, it's fascinating with so many of the stocks that have shown strength, that the indexes are still kind of flat to down, and the growthy, the mega cap growth trade is still struggling so much. When you're thinking of these from a technical perspective, what are you looking for opportunistically with any of these names that would get you interested?
Yeah, well, we're coming into earnings season. I know we're technicians. We shouldn't be focused on the earnings, but I do like to see how stocks react. And I always harken back to Google last quarter. They reported phenomenal earnings. The stock gapped higher, 52-week high on that day, and then reversed and slowly gave it all back. We saw the same thing happen in Amazon. The stocks that did well just didn't go down as much. And that is what I see in the whole technology sector. The weakest sector is the communication sector. So for me to get bullish again in technology, I think we need to grind it out a little longer. I think second half, that will be the story we focus on. But all the strength, all the momentum continues to be in those defensive sectors, in energy. And as someone that takes a bigger approach and, has studied a lot, just to get the CMT, you look at the strength of the sectors and what should be leading, what should not be leading. And the leadership is all wrong. And if I see some weakness in energy and the rotation back into the technology sector as a whole, then fine. But right now, every rally, and we talk about this here at the exchange, it's sell every rally. It's not buy the dips, it's sell the rips. And that has not changed. And then on the opposite side of that, Baker Hughes reported earnings yesterday, BKR, the symbol there. It's down, but it's holding up relatively well, given that their earnings were horrible. But given that it's in a strong sector, it may hold that 50-day moving average. It may stay at these levels because the sector has the wind at its sails. So they're not going to, punish it for having a bad quarter. So it's right now, the rotation isn't into the tech. And while Apple's doing really well, Tesla had a great quarter. It's holding on remarkably. It's just not enough. It needs to do more work. I'd like to see across the board strength and bottoming in the sector, and I'm just not seeing that. Yeah.
Katie, I would love to ask you about energy, and again, congrats on the new ETF, which is more based on tactical sector rotation. It's interesting to me that you didn't pick any energy names, and again, there's only one out of the 15 ideas was Jay's energy stock. Energy has certainly been the outlier in terms of performance, right? Relative performance, absolute performance. It's been the place to be. Are you, is it too late to be looking at some of the ideas here, or is it a good hold but not put new money to it? How are you thinking of energy stocks that have already had such a good run so far?
I think you're spot on with the good hold comment there. In terms of the momentum and the relative strength, the XLE or the energy spider is one of the holdings intact right now because the long-term upside momentum is still there behind the energy stocks. We, for the purposes of this show, looked for stocks that had kind of more exciting technical catalysts than we're seeing in energy right now, but they are generally still supported by upside momentum. And the signs of exhaustion that we've seen from the DeMark indicators have been just minor and worked off pretty quickly. So there's not really a big overhang. We are somewhat encouraged also by the action in crude oil as it pertains to the sector, in that there was a triangle formation on the chart of crude oil that it seemed to be resolved to the upside just very recently. So that could act as a catalyst for this space. But there's really plenty of names out there that we feel are very good, solid holds, like a Pioneer or PXD would be a great example of that. Names that have maybe no new fresh breakout out or catalyst, but still have the supportive upside momentum. And we are overweight the sector in our recommended sector weightings.
Yeah, so many of these names, I feel like above two upward sloping moving averages, which I always remind people that is the definition of a stock in a pretty decent uptrend. Jessica, I'd love to circle you back in and bring up one of your charts in particular. When we were looking at IT, we talked about that relationship. It tends to be a pretty good earnings name. It has done very well, and you can see the gaps in recent price history when it's had a good win. We're in the meat of earnings season right now. How do you think of the relationship of earnings to the chart? Is this a time to be avoiding looking at charts because it's all just about earnings? Or how do you combine those in a meaningful way, particularly when you have these gaps that can emerge so in some cases unpredictably?
I think it's absolutely, any price movement is important to think about. So I don't care what it's from. It could be a tweet of some sort. However, it's important to look at it and give me an idea of maybe a resistance point or a support point. That's when I'm going to look for earnings to hit or not. I am an options trader at heart, so that's also something I'm gonna look at, as well as the options activity around earnings, just to get a good idea of the implied move. And then I would utilize that in tandem with the support and resistance that I have drawn. And then normally charts do a really great job of testing those longer term resistance points or support points. And that's what I'm going to utilize while trading earnings or analyzing around earnings, is exactly what is the move and where do I expect it to stop.
That's a great answer. I couldn't have scripted some of these answers from some of you guys any better, talking about the value of price action. And I think that's spot on, Jessica. I was always taught that, in some cases, this is the best time to look, because you can understand how investors are anticipating earnings, how they, what they're doing with the stock after. You see that with Netflix, with Tesla, with so many examples that we've seen now. We're almost at the end of the run, and guys, I really appreciate all of your expertise here. I'd love to just ask you very quickly if we could finish on a bit of a macro theme here. We have the S&P 500 bringing up the chart. Currently, let's see where we're at here. We're recording this midday, and the S&P has come off a bit. It's around 44.35, 44.37. If I had to ask you the next 5-10% move, we'll call it, is higher or lower in the S&P, what would you guys guess at this point, and why? Jay, let's start with you.
I get to start. Well, some technicians would say, look, we have an inverted head and shoulders forming here, and we're going to go back up and test that neckline. You're asking this right before the earnings season, where we have some of the biggest, stocks in the S&P 500 reporting. Going ahead, I think we go higher, but I don't think we make new highs. I think we chop sideways, probably within a few percent of the 200-day moving average for the foreseeable. I can't talk today. For the foreseeable future. There you go.
You made it. You made it.
Wow.
No, that's a fair take. Katie, how would you think about that?
I actually agree with Jay in that I think we have upside here in the very near term. There's that kind of lingering sell in May and go away phrase, and that I think the upside is several weeks in nature, after which we may get into either just that kind of choppiness that he cites, or perhaps something worse than that, like the Q4 of 2018. So we're bracing for a corrective phase on the back of some near-term strength. And with that, we're recommending folks be very nimble with their positions, with an eye towards some kind of risk metric, a level below which they're very uncomfortable seeing that. And for us, the S&P has a minor support level around 43.40 that we're watching as our own stop loss of sorts, in that it's a Fibonacci retracement level that we'd be pretty uncomfortable to see it break.
Great take. Jessica, do we complete a trifecta of somewhat, I'd say, mildly encouraging commentary? What is your take? Next 5 to 10% move, do you think higher or lower for the S&P?
Yeah, 2 comments on that one. I am going to complete the trifecta. Yes, I am positive. I do believe it's a period of consolidation, though. I think that's important in between those Fibonacci lines, and we'll test those levels, but certainly upwards. And something that I was talking about on a segment yesterday, and got a lovely question on the inverted yield curve. And from a technical perspective, looking at it from an indication of a recession, that's not necessarily a predetermined indicator that will actually happen. And it takes time. But if you look at any time that the yield curve inverted, The S&P 500 is up traditionally about 17% afterwards, and it takes normally about 12 to 17 months before a recession actually hits. So due to that factor, I'm actually considerably more bullish with the inverted yield curve.
That's fantastic. I couldn't finish this on a better way. I was a little scared I would get some we would get some dark and dreary conclusion to the discussion, but there is a light there for all of you. Listen, you guys, you're fantastic. Really appreciate you sharing your expertise. Jay Woods from DriveWealth joining us from the New York Stock Exchange. Katie Stockton from Fairlead Strategies joining us from Connecticut. Jessica Inskip joining us for the first time from OptionsPlay in Jacksonville, Florida. Thank you guys so much and really appreciate you joining us today.
Thanks, Dave.
Thanks, Dave.
And everyone, it's a pleasure to have you join us. You can see all of the information on this episode and our previous episodes on our website, StockCharts.com/thepitch, and all of our content on StockCharts TV, including our special interviews with great experts like Jay, Jessica, and Katie. Also special events like our StockCharts draft coming up next week for free at StockChartsTV.com. I'm Dave Keller, Chief Market Strategist at StockCharts.com. Have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.